Hello, everyone. Welcome to our live Q&A broadcast. I'm Bill Moore. I'm the Chief Risk Officer at Compeer Financial. And I want to start off by recognizing the essential nature of farmers. And I want to thank you all for the hard work you do for producing food for our country. Thank you for all the work that you do. Maybe you've done this before, but this is my first Facebook Live post. So you may already know, if you have questions, you can submit them in the comments. I'll do my best to answer them as they come in. We have a team that's monitoring it as well. And if we run out of time, we'll try and provide responses thereafter. So, all right, we're all sitting at home, but it does give us the chance to have these updates. I know there's some seed in the ground, and I know, in places there is snow on the way. I personally will be happier once I can social distance on my boat. We're not quite there yet. I do get to see myself on video here. It's a little scary. I haven't really trimmed my beard in over a month, and my hair definitely needs a cut. However, working from home is relatively normal for me. This is my traditional work setting. I don't have an office per se because I travel a lot. So I do miss that. Having everyone at home is a little interesting as well. I have two teenagers back at home under the same roof. And frankly, if we all make it out of here alive, it'll be a big win. The two of them only really bond over cookie making, so ultimately, I'm the one who loses. We know at this time there's a lot of uncertainty and volatility in our industry, and today I'm here to provide some context on the markets and on interest rates over the past month, and I hope that you gain some helpful insights from our discussion today. Some background. I've been with Compeer for about 6 years now. My previous life, I was a fixed income portfolio manager for about 15 years. So sort of apropos to what we've been trying to monitor these last 30, 40 days. I lived through the 2007, 2008 market gyrations. And while the factors are different, the market trading feels kind of the same, really gut-wrenching moves up and down. I think we went 11 straight days with a 1,000-point move in the Dow Jones Industrial Average. So very interesting times indeed. If you've heard me speak before, you know that I've been calling for a recession in the, quote, upcoming 12 months for about 2 years now. The economy was in the midst of the longest expansion ever. Asset prices were high. Economic statistics were fragile. But in the end, expansions don't end on old age. Rather, they come about because of a catalyst. And in this case, unfortunately, coronavirus was that catalyst. Now, there's two principles you should think about with the market. One, they don't like uncertainty. And two, the market reacts hard to things they didn't expect. And really, this is the mother lode of all uncertainties. And when those two things come together, it translates to what we're experiencing in the market today. Asset values are essentially, they're the sum of all the interested parties' expectations. And when those expectations are all over the place, we end up settling on what's the lowest common denominator of value. March may go down as one of the worst months in market history, and it wasn't just stocks. As painful as the stock market declines are, the scariest part of March was that all the other markets fell apart. We had rises in volatility in the options and the derivatives market. We saw big changes in the commodities market. We saw credit market deterioration that made them really, really fragile. And what was probably the most scariest was we had disruptions in the treasury and the mortgage market. So ultimately, what happened? The effects of the virus and what it meant to the world economy really began to become more prevalent in, call it, late February, early March. And what does that turn out? That turns into risk aversion. And what is risk aversion? Well, it's essentially selling riskier assets and buying risk-free assets. And there's no perceived safer asset in the world than U.S. Treasuries. So hang on, let's talk about bond yields for a second, just so we all understand. Bond prices and bond rates, known as yields, are inverted. Treasury bonds are traded like any other asset. More buyers equals higher prices. And remember, I said rates are inverted with prices, meaning they move in opposite directions. So higher prices equals lower rates. And that's exactly what happened. Global investors bought so many US Treasury bonds that by March 9th, the yield on the rate that you would normally earn on a 10-year Treasury bond, and remember that yield, on the 10-year Treasury moved to an absolute level of about 50 basis points, or a half of 1%. It's the lowest levels that we've seen in really ever. And the chart looked like this. And yet, this isn't where it got crazy. People started to realize what this meant for the US over time. The cases were beginning to emerge on our home turf. When did that realization come for you that things were getting crazy? For me, it was when my daughter called me on the phone and told me the NBA was shutting down. It was March 11th. I specifically remember. I didn't believe her originally, but ultimately, when you look back, so much has changed since that date. Now, money in the US financial systems moves fast. All of a sudden, nobody wanted assets with any type of risk. They wanted the safest of safe money markets. I think the single largest outflow in any week in US corporate investment grade bond history before 2020 was about a $5.1 billion exodus of cash. Now, the week of March 11th, 7.3 billion flowed out of investment grade bonds. But the following week, the week of the 18th, $35 billion was taken out of US investment grade bond funds and put into the safest of safe money market accounts, which in total saw an inflow of about $250 billion. Now, these are the markets that companies rely on for their traditional daily or weekly funding, and they were closed. So I think it must have gotten real for US corporations on that day, March 11th, too, because that was the day that Boeing, the aircraft manufacturer, drew down its $14 billion revolver just to make sure they had liquidity, just in case. Wanted to make sure they had the cash in the bank, in their hands. Now, remember those two rules of thumb, uncertainty and unexpected. And those two things both fit that same case. Now, US corporations have $1 trillion worth of credit capacity with banks. Now, I don't know if you like bank robbery movies, but I can tell you that large national commercial banks, they don't have $1 trillion lying around. What do they have? US treasuries, and lots of them. So there was this sudden rush on cash. Banks were selling treasuries to make sure that they had liquidity. Now, Warren Buffett once famously said, liquidity is like oxygen. You don't think about it until you don't have it. Now, prices are set with supply, demand. Lots of sellers, few buyers. And prices and yields, remember, they're inverted. So lower prices, higher yields. Yields on the 10-year Treasury more than doubled from that 50 basis point number. They moved up to 1.2% in a matter of days. It wasn't that anybody was scared about the credit risk of the United States government. It was all the banks wanted cash. The volatility in Treasury prices in a single day was more than the Treasuries usually saw in a month. And it was just like the virus. That thing was contagious. Bonds issued by Fannie Mae and Freddie Mac, which drive the vast majority of mortgage rates in the country, they just stopped trading. There were no buyers. Now, I'll give the Fed some credit. They kind of saw it coming, kind of. They were nervous about the global economy late last year and made notations about it as early as November. But it was their cuts in March that showed their resolve and their concern. The Fed has a committee, it's called the FOMC. It meets about once a month, and it sets what's called the Fed funds rate. That's the rate that banks can borrow money from the Fed. Their rate increases or cuts typically come at those once a month meetings. Now, 8 times since they started announcing their changes in 1992, they cut rates between meetings. They cut rates twice between the meetings between February and March. March 3rd and March 16th, which of all days was a Sunday. So why do you cut rates? Why does the Fed cut rates? Well, lower rates, particularly the Fed funds rate, encourages banks to lend, but it also promotes liquidity. There's that term again. They want to make it easy for banks to have access to funds. The Fed had cut the bank borrowing rate to 0%. It's the number we see in the newspaper quite regularly. But ultimately, that wasn't enough. Recall, very liquid securities were not trading because there were no buyers. So the Fed stepped in and bought, and bought, and bought some more. In the last month, the Fed's balance sheet has risen by almost $600 billion. Now, they single-handedly created a market for government-guaranteed securities. Supply-demand was now favoring a buyer with unlimited resources, and rates moved back down again. Someone asked me, where would rates be if the Fed had not intervened? Well, what's the price of an asset that has no bid? It's really hard to say. Now, U.S. Treasuries would have likely found a level that investors would have bought, but it's really hard to say where. The Fed action did help, and it helped a lot. But rates have only gone back to those near lows for just the government securities that the Fed was buying. There's a still risk premium for everyone else. Risk premium is the spread that investors need in order to take on risk themselves. And it's often discussed in relationship to U.S. Treasuries. So here you have U.S. Treasuries. This is the value that they trade at. Most securities require some sort of risk premium on top of those Fed rates. Now, in many cases, we saw the Fed rates go down. But when risk aversion takes hold, the investors require an additional set of risk premiums to make a purchase. So while the treasuries declined, the rates may have stayed the same or really not changed as much. Some risk premiums are bigger than others. High yield spreads, they're off their widest levels, which were very wide in mid-March, but they're still nearly twice where they were 2 months ago. Investment grade bonds, they're better too, but they've only come about halfway back. So treasury rates are low when the Fed's buying them, but the risk premiums on other securities are still wide. So borrowing rates may have moved down, but haven't moved to the same extent that treasuries have. Unless you're the US government, which I don't think anyone on this call is, some form of risk premium comes into play no matter who you are. Now, farm credit borrowing is no different. The farm credit system borrows money at a AA plus rating. You've probably seen that. We get our funding at spreads, it's very similar to here. We're getting funding at spreads that are better than investment grade companies, but still have a risk premium built into them. The good news is even when the markets were turbulent, we still had access to funds. Our office doors were physically closed like most other businesses, but funds were flowing. It came with additional risk premium, but access to lendable funds wasn't the case everywhere. Some lending institutions didn't have access to new funds to lend. Other lending institutions moved away from ag to fight fires elsewhere. The improvements in the credit markets have been key for farm credit funding in that it's taken the absolute level of rates down. The Fed is taking quite a bit of actions, but honestly, buying farm credit securities is not one of them. As such, we're really reliant upon investor perception that the market gears are greased efficiently, and we're beginning to see that. We still need to manage investor appetite because we're still issuing to a certain set of buyers that don't have unlimited resources and have other places to put their funds. So while treasury rates have bounced around and eventually went down, our risk premiums, this top piece here, were still fairly wide, or wider than normal. The height of the mess, our 5-year spreads were 25 to 50 basis points higher than we've traditionally seen. It has improved in recent weeks, but it's still higher than normal. So rates for buying land or operating line, they went down, but they didn't go down nearly as much as the Fed funds rate did, which went to 0, or US Treasuries. The home mortgage market is similar, but it's also different. We could do a whole 15 minutes on that alone, but in a nutshell, the same factors that we just talked about apply to the home mortgage market, plus some additional disruptions. Mortgage bonds maintain this additional premium, not only because of possible default, but also this concept of forbearance, the right to defer up to 3 months of payment due to the COVID. Not only did mortgage lenders get whipsawed by market volatility, but they now have to finance up to 3 months of interest and principal on the loans that they service. And when you build up the price of a home mortgage bond, you start at the rate that investors are willing to buy at. You add a fee that you pay, say, Freddie Mac in order to guarantee the payment, but then you add on a spread that it allows them to earn a profit. Now, historically, they were able to offset some of that need to make a profit by the fact that their mortgage servicing rights had value. But because of the forbearance issue, the value of servicing rights has actually turned negative. So what was once something that made spreads lower in the mortgage market now requires spreads to be higher in order to make up the difference. And if you're talking about mortgages that aren't sold to Fannie or Freddie, forget about it. Jumbo mortgages, which are the sizes above what Fannie and Freddie buy, that market is grinded to a halt. Jumbo mortgages used to be the hot product. They'd be 20 to 50 basis points lower than conforming loans. They're now over 100 basis points wider because originators can't get them funded. So while we see headlines of 0% rates, the reality is those aren't borrower rates. The disconnect in the market, in some ways takes borrower rates up, but in other ways it takes it down. Uncertainty still persists, but we're far from a normal state. The ridiculously poor market conditions are probably behind us. Baseline treasury rates are back to a normal looking structure. Even with that built-in risk premium, rates are still historically low in absolute terms, and they're likely to be an opportunity to be low for a long runway for borrowers. We're set to see some really bad economic numbers into the market. GDP, unemployment, they're all going to show really bad reports. But the Fed has promised to keep rates low until we weather this mess. And Fed fund futures, say that 10 times fast, are forecasting for rates to stay near zero through the balance of the year and into 2021. Now, rates could go lower. We've seen negative rates in other parts of the world. I don't think that's going to happen here in the United States, but they could easily also go up. In fact, I've seen forecasts for 10-year treasury rates to go up between 15 and 30 basis points throughout the balance of the year, depending upon your prediction for the speed of recovery. But back to here, even if treasury rates were to go higher, and this was to get bigger, it probably means that things are getting better. So that means that your risk premium, this piece, it's going away. So now you're just back to your normal levels. So you can see treasury rates go up, but yet borrower rates still stay where they are or even potentially lower. So on this theory, I expect low rates to be around for a while. I'd like to thank you for your time and attention today. I hope this helps. For further information, or frankly for blatant self-promotion, you can follow me on Twitter at Bill Moore, ROIC, for return on invested capital. And I'm happy to take your questions there. I think we're probably out of time. I'll take a look at our bulletin board here. And otherwise, we'll wrap it up and say thank you again.